All right, team, this is a robust question, but what we need to do here is go through the financial information that we have for Blippy Ventures and then figure out what's included in the calculation of net income versus what would be excluded from this calculation. So we'll take a quick refresher look at the multi-step income statement so we can see how to arrive at net income, right? So we'll start with sales, subtract out cost of goods sold. That gets us to gross profit. And then we'll subtract out operating expenses, and that takes us down to operating income. And then we need to factor in non-operating income and expenses. Now, in this question, it also gives us an effective income tax rate of 30%. We can't forget about income taxes, so that's going to be the last calculation that we do here. So as I mentioned, we'll first go through and figure out what should be included in the calculation of net income. So on the first one, revenue definitely is included in net income. Cost of goods sold is as well. Now this next one's a bit tricky, right? The effective portion of a cash flow hedge. So for a cash flow hedge, the effective portion, that is going to be recorded in other comprehensive income. And we have our FUPI mnemonic to help us remember that, right? And the E is the effective portion of the cash flow hedge. Now, if it's ineffective, we would record that directly into the income statement. But again, since this is the effective portion, then it's going to be recorded in OCI, which is not part of our calculation of net income. So how about foreign transaction losses? So foreign transaction losses, this occurs when we transact with another unaffiliated party, and we as the company, well, we lose out because there was a change in the exchange rate from the time that we settled into the arrangement versus when we actually received payment or paid a vendor, right? And so a transaction loss gets recorded in the income statement. Now, I know that sounds a lot like a translation loss because translation gains or losses, which is the F in our FUPI mnemonic, well, those get recorded to other comprehensive income, but this is a transaction loss. These losses will be recorded directly into the income statement under the non-operating section. How about selling expenses of $50,000? Well, selling expenses, those are part of operating expenses along with general and administrative expenses, which is our next line here. So all of those expenses will be included in operating expenses and will be included in our calculation of net income. How about a realized loss on a trading security? So we'll get into trading securities more later on in FAR, but what we need to understand about a realized loss is that we have actually sold the security. And those realized losses, those are recorded directly into the income statement, especially since it's been sold. So that $5,000 will be included in our calculation of net income. How about the repurchase of outstanding common stock? Well, when a company repurchases outstanding common stock, that is now known as treasury stock. And treasury stock reduces the amount of common stock that's out there, right? So it's a debit to equity, basically. It's reducing our amount of equity. But the offset to that is going to be a credit to cash. So the point is there's no impact to the income statement or net income here. This is only going to be a balance sheet impact. So we're going to exclude that from our calculation of net income. And on our last item here, cash dividends paid to shareholders. So dividends that are paid to shareholders, especially in cash, those only come out of retained earnings, right? There is no impact to net income. Now, I know net income flows into retained earnings, but that's after we calculate net income. So when we look at the journal entry for dividends that are cash dividends, well, when we initially declare those dividends, we must record a dividends payable, which is a liability on the balance sheet. But then when we go ahead and pay those, well, we would debit dividends payable to remove the liability, and the offset is a credit to cash. However, as you can see, the initial debit is not to expense, it's to retained earnings. And so again, there is no income statement impact there, just a balance sheet impact. So now that we've gone through all the items, classified which items will impact the income statement versus which items won't, we're ready to prepare our year 2 income statement for Blippy Ventures. So the first part of our income statement is going to be revenue and gross profit. So we'll start with revenue of $250,000, subtract out cost of goods sold of $100,000. That gets us to gross profit of $150,000. So now we'll move on to operating expenses. And remember, that's going to be selling expenses and G&A expenses. So selling expenses were $50,000, G&A expenses were $30,000, so a total operating expense of $80,000. So subtract that from gross profit of $150,000, and that gets us down to operating income of $70,000. So now that we have operating income, we can move into items that were considered to be non-operating. So the first item there is going to be realized loss on trading security. That's negative 5,000. And then we had foreign currency transaction losses. That was also a negative 5,000. So that gets us down to income from continuing operations on a pre-tax basis of $60,000. Now this is where we apply the income tax rate of 30%. So it's real simple. We just multiply 60,000 times 30%. That means our income tax expense is going to be $18,000. So 60,000 minus 18,000, that means income from continuing operations is going to be $42,000. Now this is essentially net income, but I've shown you one last piece here that would account for discontinued operations if they did exist. Now, the question doesn't indicate anything about discontinued operations, so we'll leave that blank. And so that gets us down to net income of $42,000. And that's going to be the correct answer, right? So we have our full income statement for year 2 for Blippi Ventures.